Welcome, folks. This is Professor B again. Today we're going to be covering exercise 5-3 in Business 198, bond elimination and straight line, using straight line method, because this problem is sort of new for us. We've been dealing with consolidation so far, but we haven't looked at any situations where we had complications like we do in this chapter, where we have intercompany transactions between a parent and a subsidiary. And as we learned in the previous chapters, whenever there are intercompany transactions, we need to eliminate them because the parent can unduly influence the subsidiary to accept terms that are not favorable to its shareholders and or they are not fair for the market in large. So we are going to be doing that in this problem. We're going to be eliminating intercompany transactions. And I kind of allude to it in the notes here as well. Why are we eliminating intercompany transactions? And you can kind of read through this, but that was the gist of it that I just mentioned. Before we get that far, though, I wanted to shed light on some very basic concepts in bonds, because it may have been a while since you've taken intermediate accounting where we covered this concept in detail. But basically with bonds, you have a situation where there is a company that needs to expand and they need a large sum of money that they cannot get from a bank down the street. So they issue bonds. Bonds, just like any other debt, is a promise to repay the creditor at some point in the future along with interest throughout the term of the debt. And it just so happens that anytime you have a debt that's longer than a year and it's represented by some sort of a bond certificate, it is known as a bond debenture, right? As in a debt. Normally, this is not an issue. Normally, whatever the coupon rate is on a bond certificate is what the company will need to pay to its creditor over time. And it'll always spell that out for you, right? It'll always say this is a $5,000 bond and it pays 10% interest or 8% interest or whatever it is. And they continue to make those payments to the creditor till the end of the term or until the bonds retire. Upon issuance, though, sometimes the market may or may not coincide with that coupon rate. Let's assume that we are offering a bond rate at 8%, right? That's the promise that we have made to our creditors, that no matter what happens throughout the term of this bond until it retires, we're going to be paying you 8% annually or semi-annually, whatever the rate, whatever the interval is. And that's all well and good. They're guaranteed that amount. They're happy. However, we realize that the market is offering a 6% return to those same investors if they don't go with our bond. So all of a sudden we're like, we are offering a substantially higher interest rate on this investment than Mr. Creditor you're able to get out in the market. So guess what? We're going to charge you a premium. So we sell the bond at a premium. We take more money for the same bond that's paying 8% and will continue to pay 8%. Because remember, the coupon rate, the face rate, will continue to pay what it is paying. But we're going to now charge a premium for the creditor to have this option. Right? That's the idea behind a premium. What if the market rate happens to be 8% at the time we are issuing our bonds, which is also offering 8% as a coupon rate? Well, then we have no leverage. Our product is just as good as what's selling in the market, and as such, we cannot really command a premium on this. So we're going to sell it at face value. If the bond were, say, $5,000, let's just say, then we're going to accept $5,000 and continue to pay the creditors 8% over the term of the bond. What happens, though, if the market rate, the prevailing market rate a creditor can get out there is 10%? Let's say they can earn a 10% interest rate. Why in the world would they want to purchase our bonds, which carry similar risks, but they're only offering 8%. Now the situation has reversed. So we tell the potential creditors, hey, invest in our bond and we'll give you a discount to have our bond. We'll accept less money today than what the face value is of the bond, say $5,000. So we may accept, say, $4,800. And if you purchase our bonds, we'll give you that discount. Yet we'll pay you back the face rate that the face value that is written on the bond, which is 5,000. So you gave us $4,800. We're gonna give you back 5,000 at the end of the bond. And the creditor's like, okay, well, this sounds like a good deal because even though I'm not getting the highest amount of coupon rate, at least I'm getting a discount on purchasing this instrument. And so this is a reason why bonds sell at a price different from its face price. Because you see, the interest rate in the market fluctuate on a daily basis. And an issuer of the bonds cannot possibly reprint, re-advertise, remarket the same bonds based on what the market is doing. They just figure out a way to sell it at a premium, face, or a discount depending on what's happening with the market. To use an example, let's go with a discount. Let's say that we're offering a bond that's got a coupon rate of 8%. We're selling just one bond, just for sake of this example. The bond's face value is $5,000. And let's say that it will last 10 years. Similar to the problem we have in exercise 5-3. And let's just say that the market rate is 10% at the moment. So the creditors / the investors are wondering why they should buy our bond that's only offering 8%. We tell them, hey, we'll give you a discount if you purchase this bond. So how would that look when it comes to recording the journal entry? From our point of view, we have an obligation now, since we have issued a bond, to pay that bond down the road, known as bond payable. Please remember that this line will always be what's on the face of the bonds. The bond payable line will never change. However, since we are selling it at a discount, and there is a math behind this, which we cover in intermediate accounting, where we take a look at the present values of all of the payments we're going to make for interest, plus the present value of the $5,000 down the road, and we discount it at the market rate, right? We figure this out. We figure out exactly what it is how much exactly we need to accept. But that's beyond the scope of this question right now. And for now, I just want you to assume that we're gonna give them a discount of $200, right? So we'll accept $4,800 for this obligation that we have to pay down the road, and we're going to accept $4,800 for it. So I'm gonna go ahead and accept that cash, $4,800. The NAs don't matter because I'm just using them, just making this example up. But the logic is still sound. All right, so how do we balance this journal entry? How do we ensure that the debits and credits are equal? Because now we have accepted cash, yet we have an obligation to pay $5,000 more so than what we accepted. Well, folks, the solution is to create some sort of an account, or rather a contra account, that attaches to the bonds payable, which when netted together with the bonds payable account yields us the true value of the bond, or rather the carrying value of the bond as of today. So if I were to record a debit to discount on bonds payable for $200, first of all, my debits and credits will equal, but more importantly, I'd be able to show to the end user, hey, I do have an obligation to pay $5,000 down the road, but because there's a discount that I offered on this bond of $200, its carrying value today is really $4,800. Thus, our journal entry looks like this. We have accepted cash, a bit less than what we plan to pay back or need to pay back, yet we need to record it properly in a journal entry format into our accounting system. What's interesting is that this carrying value is not shown anywhere on the balance sheet. It is something we infer, right? We have the bond value as bond payable on our balance sheet in the liabilities section, and along with it, you'll also see a contra liability account called discount on bonds payable. Contra accounts, if you'll recall, are simply accounts that diminish or affect the value of the parent account, in this case, bond payable. And when we net the two together, we can figure out what the carrying value is. In other words, this is what we would have to pay off the creditors today if they ask for a refund, theoretically speaking, of course. This is a carrying value. So it kind of lets us know what we are on the hook for as far as our obligation is concerned. This is all well and good, and now you're wondering, okay, that makes sense, but what happens to this discount on bonds account? What happens to it? Well, the interesting thing about this account is that once the parent account, the bond payable, and we're writing that down as bond value, that once a parent account ceases to exist at the end of the term, this discount on bonds also needs to end at that point. In other words, if we were to take this $200 and somehow make it zero, then our carrying value would be the same as our bond value. We would pay off the $5,000 owed at the end of the term of the bonds, get rid of bonds payable from our liability section, pay the cash off that we need to, and be on our merry way, right? That's what theoretically should happen. This discount on bonds payable, therefore, needs to be eliminated over the term of bonds. This is known as amortization of discount on bonds payable, where we take 1/10 of the bond, which is 20 in this case, and we destroy it by expensing it over the term of the bonds. Why 10 years? Because that's a term of the bond. We want to, on a straight line basis, eradicate this discount each time we record an interest payment. And if we do this enough times, if we do it specifically 10 times, this $200 should go away, right? 20 times 1, 20 times 2, 20 times 10 would be $200. And if somehow we could destroy that discount on bonds payable, then we would end up in this situation where the carrying value is the same as the bond's face value. We could just pay for that with cash and be done with this situation. That's what happens in real life, by the way. When you amortize on a straight line basis, this is what the exercise is calling us to do. There is something called an interest method or effective interest method of amortization of discount. And we do cover that in the previous class in the intermediate accounting as well. But again, I want to stay focused on the intercompany transactions here. So I'm going to limit my lecture and just talk about how the whole purpose of amortization through the term of the bond issue is to destroy the discount on bonds. That's the whole point. Whether you do it on a straight line basis, whether you employ some other method like the effective interest rate method, none of that matters. What truly matters is that we want to get rid of that discount somehow. And by amortizing it, each time we make an interest payment, because remember, we as a debtor, we need to pay our investors, our creditors, some interest for giving us this sum of money, right? That's what we promise. We promise to pay them the bond coupon rate no matter what happens. So if this is a semi-annual issue, then we would do it every 6 months. If this is an annual interest, as is the case here, we'll do it annually every time we make an interest payment. this is how that would look like. Okay, so let's continue onwards. Let's say we've recorded the issuance of bond correctly. We've accounted for the discount on bonds payable as a discount of $200. We've accepted $4,800 in cash. And now a year has elapsed, and now it's time for us to pay our creditor the amount that we said we would owe them, which would theoretically just be the face value times the coupon rate. Because remember, this is what they have in their hands. This is what they're expecting to be paid, right? So typically when we pay our creditors, we would credit cash, excuse me. And this would typically just be the $5,000 that we have per bond issue. And typically there's like thousands of these issues, but I just want to keep saying things very simple. So let's just say we just have one bond for $5,000 and we want to pay them 8% because that's what we promised to pay them. You will never have to look at the market rate ever again, because that had only to do with the issuance price. Subsequent to that, on the interest payment date, we will look only at the face value and the coupon rate that was on the bonds certificate, because that's what we owe. All right, so the creditor are expecting a check for $400 from us, and so we're going to give that check to them. However, we had this issue where on our books we needed to somehow eradicate this $200 in discounts. And that's what we need to do as well on the interest date. We need to take 1/10 of it, or whatever the term of the bond is, and so inverse it. So if the bond maturity happens in 20 years, you would go 1/20. If it happens in 5 years, you would go 1/5, right? You want to take 1/5 or 1/10 of that chunk for each of the 10 years that the term exists and destroy that 1/10 share. So in this scenario, we said it was 10-year bond. So let's just say that we have a discount of $200 here divided by 10, that's $20. We want to destroy this account called discounts on bonds payable by a factor of $20. Because it was previously a debit, you would want to now credit this for $20, right? And the sum of these two goes to our interest expense. Some interesting things happen here. One, I can't indent correctly, but more importantly, we are allowed to recognize additional interest expense as a result of amortization of the discount on bonds payable. Why is that? Well, from the point of view of the IRS, they say you got screwed on this deal. You have to pay back $5,000 even though you only received $4,800. And so we are going to allow you to recognize additional interest expense, which will eventually lower your taxable income and thus your tax. So the IRS says, you know what? You can go ahead and recognize additional expense in the tune of $20, the amount of discount that you're amortizing each period. Notice what has happened with this entry at the end of the year when we owe when we owe interest to our creditors. They get their money. We get to destroy part of that discount that's on our books. And by the way, the discount on bonds payable now should be 180, because 200 minus 20 is 180. And we get to recognize additional interest expense over and above what we paid in cash. So this is about leveling the playing field between the seller and buyer of a bond, where the buyer of the bond, the investor, made or got a good deal because of the market condition, but we want to level the playing field for the seller as well and say, hey, you know what? As much as possible and reasonable, we're going to allow you to recognize additional interest expense. And by the way, this is going to happen over and over. right? This is going to happen at the end of year one, it's going to happen at the end of year two, and so on and so forth until the end of year 10, where we're going to again pay at the anniversary of year 10, at the end of this bond issuance term, we're going to pay them another interest. And by the time we've paid discount on bonds 10 times, it would have been equal to 20 times 10, which is 200. And 200 in credits would have destroyed the 200 in debits on this account at the end of this term. So this line would cease to exist. And all we would have is this bonds payable left on our liability section, which we're going to pay with cash and get rid of it. That right there is the entirety of the complexity revolving bond issuance. And it sounds hard, but when you go through this, it'll make a lot of sense. So practice on this problem itself, and you're going to realize that none of this stuff is really that complicated. It's so new for us at times, and we're not used to working on this, that we feel that it's impossible, but it's really not. And so that's what we need to do in this problem in exercise 5-3 for the first few steps. And then we need to deal with the intercompany situation next. Now that we have gone through an example that illustrates how we deal with an issuance of bond sold at a discount, and it's very similar to what happens with premium as far as the logic is concerned, but because this exercise revolves around a discount, we'll stay with discounts. And now that you've seen how an issuance is recorded with a discount, as well as how we amortize it over the term of the bonds, let's take a look at exercise 5-3, because it's very, very similar to what we just covered with some nuances, and we'll take a look at that together. In exercise 5-3, Cardinal Company is an 80% owned subsidiary of Dove. So Dove is a parent, Cardinal the subsidiary. Cardinal issues $100,000 of bonds, of 8% bonds, 10-year term for $96,000 on Jan 1, 2011, right? As of this point, we don't have anything to concern ourselves with as far as a parent is concerned. Right now, they just have sold some bonds to an outside party. On Jan 1, 2011, these bonds have a face value of $100,000, coupon rate of 8%, and a term of 10 years, and they were sold for $96,000. I hope the previous lecture that you went through a few minutes ago, I hope you realize why we're selling this at $96,000 when it's really worth $100,000. And the reason is we're selling it at $96,000 is because we're selling it at a discount, for obvious reasons that the market is probably paying more than the coupon rate of 8%. The math behind it is not necessary at this point. What I want you to do is follow the example I gave you and work on just recording the issuance of this bond first. So now we know that we need to record 100,000 of bonds payable. We also know that we received only 96,000 because that is the discounted amount we accepted based on the fact that our offering was not as hot as the offerings in the market, presumably, and thus we have a discount of 4,000, which is of course the bond face value minus the cash that we received. All right, so that's $4,000. That's a discount on bonds payable we spoke about earlier, where we have to eventually destroy it by the time the term ends, and then we'll just pay back this 100,000. Right? This was all done to entice the investors to invest in our product. Would it be better if we don't offer this discount? Would it be better if we don't get anybody interested in our bonds? Would it be better if we cannot have enough cash to finance our next project? No, none of those scenarios are good for us. So we happily accept this discount. Excuse me, we happily accept this discounted amount so that we have the money that we need to do whatever it is we need to do, right? And so if this were done on 1/1/2011, what do we need to do on 20/31/2011? Well, at that point, a year would have elapsed, and we would owe some sort of an interest expense, excuse me, an interest payment to the creditors. And though we can call it cash, or we did call it cash in our previous example, it's simply some sort of an interest payable, right? Interest payable or cash can both be credited to show that we owe money and that we have paid or we haven't paid. But either way, it's some sort of a payable that we need to pay them. And that's probably the easiest part, right? Because we know that the interest payable or the cash that we need to pay is 8% of $100,000. That's a payment we're going to make to the investor because that's what we promise we will give them. We promise that we'll give them 8%, excuse me, I thought I had that up there on the top. But let's say we look back at the question, it says 8% of 100,000 is what we pay in coupon payments or interest payments to the creditors. And we have done so by calculating this amount at 8% times 100,000. And normally if this were sold at at face value, then that would have been the interest expense, $8,000. But that's not the situation here because we know now that we have some sort of a discount that we have to contend with. And because this is a 10-year term limit, we simply need to divide 4,000 by 10 and amortize 400 annually, right? So that's simply 4,000 divided by 10. The addition of these two will of course be our interest expense, as I previously mentioned. We are allowed to recognize additional expense because initially we had an unfavorable situation. And this is a way for GAAP/IRS to even the playing field, so to speak. And interestingly enough, because this is on a straight line basis, all of this will simply repeat itself every year, right? So I'm not going to go through all of that, but I just want to show you that each year it's going to be the same darn entry until some intercompany transactions occur. So up until that point, we're good to go, and we're going to continue to repeat this entry, destroying $400 of our discount each term until something else happens, which our book says that Dove Corporation purchases those bonds. Dove, remember, was a parent. So Dove purchases these bonds on Jan 1, 2015 for $101,500. Ooh, interesting. They paid more money for this bond, which, remember, is still showing a face value of $100,000. So the parent company comes along on Jan 1, 2015, goes ahead and purchases these bonds from a third party. And typically, if they had no relation with Cardinal, this wouldn't pose an issue at all. This would be just some random third party purchasing bonds from the second party we sold it to originally. But because we are in a parent-subsidiary relationship here, some interesting things occur. However, before we get to that point, please finish out these remainder of these items, because I wanted you to go through these steps to understand the flow of steps, how things develop over time, so that you could practice and master this concept up until 2015, when the parent purchases these bonds that were initially issued by the subsidiary. Now that you've had a chance to finish out the rest of these journal entries, which are pretty much identical, let's move onwards to Jan 1, 2015, when the parent purchases all of the outstanding bonds of the subsidiary on Jan 1, 2015 for 105, 101, 500, excuse me. So that year, the subsidiary is going to record yet another interest expense entry. But what happens with the parent, we want to record that as well, beginning Jan 1, 2015, because that's the date the parent purchases all of the outstanding bonds of subsidiary. They will expect some interest in that year, but it won't be due to them until the end of the year. That makes sense. All they can do on Jan 1, 2015 is record the investment. So they tell us that Dove Corporation, the parent, purchased the bonds on Jan 1, 2015 for 101,500. 101,500 is what they paid in cash for investment in the bonds of the subsidiary. And I'm going to just jot that down as investment in bonds. The chapter tells us that in elimination entries or consolidations, we can link the investment face value as well as a premium they paid in one line to facilitate elimination. And I read that specifically on page 269. If you read the last paragraph, it says worksheet procedures may be aided by linking the bonds payable and the related discount or premium on the worksheet. So we're just going to put it together just because we don't need to segregate that for now. We just want to show that the parent has purchased the outstanding bonds. At the end of the year, we're going to record the interest due to parent. Again, this peach coloring here represents the accounting books of the parent, the greenish, the accounting books of the subsidiary, just to clarify and make sure we are straight. All right, so at the end of the year, the parent wants to accrue the interest that is owed to them for having invested all of this money in these bonds. Let's do that now. We know now that the interest receivable, or that money that we expect to receive, is basically 100,000, the face value of the bonds times the coupon rate that the bonds state is on them. So again, it's $8,000. But this time around, since we had some sort of premium associated with this investment, our interest revenue is not going to be identical to the $8,000 that were received. It's going to change. So let's take a look at that, what that means. Please note that whether it's a discount or a premium, we need to amortize or destroy it over the remainder of the bonds. So in this scenario, we now know that the premium that was paid for these $100,000 bonds was $1,500, which is 101,500 minus 100,000. So we know that the premium paid was $1,500. We just now need to divide it by the number of remaining years of the bond. Okay, so how many years is that? Well, let's see. Parent purchased bonds on 1/1/2015. That means 4 years have elapsed already. They come in on the 5th year. To help us with this, I drew up the time the moment the parent purchased the subsidiary bonds on 1/1/15. And up until then, from 1/1/11 to 1/1/15, 4 years had elapsed, 1, 2, 3, 4, which means the moment they purchased it, they had 6 years remaining before the term runs out, right? The term runs out from 10 years from now, which puts us at 1/1/21 or 12/30/120. But in any case, 4 years have elapsed. That means 6 years remain. So what we need to do here is we need to destroy that premium that the parent paid over a period of 6 years, which is 1,500, as we just realized, divided by 6. And they're going to have to amortize that amount Remaining out of 1,500 by eliminating 250 of it as a credit to investments in bonds, and the remainder of this will be recorded as interest revenue, which is 8,000 minus 250. All right, now that we have recorded all of the associated entries for both the parent and the subsidiary, we need to eliminate the intercompany transactions for the year 2015. Not before, but starting 2015, because that's when the relationship comes into question, specifically the intercompany transactions, because that's when the parent purchased the bonds of subsidiary on 1/1/2015. And why are we eliminating these intercompany transactions? Well, aside from the fact that when you have a member of consolidated group, you want to ensure that you don't have intercompany transactions, primarily because you have created a situation where the parent can unfairly dictate the terms to the subsidiary, and they can just ramp up random amounts of monies, and that violates the arm's length transaction principle in accounting. The arm's length transaction states that in accounting, we assume that all transactions are fair because the party that you're transacting with is not under your control. So this violates that. So we need to ensure that we free our consolidated financial statements of all of these intercompany transactions, which began on Jan 1, 2015, the moment parent purchased the subsidiary's bonds. How do we do this? Right off the bat, delete the intercompany receivables and payables for the year. Note that those are the $8,000 amounts. Then we need to eliminate the income and expense items related to the bonds for the year. And we need to eliminate the investment in bonds along with the bond payable for the subsidiary. Then we are going to combine all the net assets together for the group, which will reflect the assets of both the companies minus the bond investment or payable, right? That was the intercompany transaction. So let's get started with that. Right off the bat, the first thing you need to do is delete the intercompany receivables and payables. These were 8,000 for the year 2015. So we get rid of that. We free our financial statements of that. Go ahead and eliminate the remaining items pertaining to the bond issuance, not only for the subsidiary, but also for the parent. For the parent, the items that we need to consider eliminating are the revenue, interest revenue that we have been recording this year, that we recorded this year, the investment in bonds account, as well as any pertaining amortization of that investment in bond. I remember the 250 that we did. We'll deal with that in a second. As well as what pertains to the subsidiaries accounts. So the subsidiary has a bond payable line we need to eliminate, discount on bonds payable, and whatever was the amortization this particular year in 2015. So let's start with the parent. The interest revenue the parent recorded is up here, 7750. I'm just going to jot that down here as a debit. It was previously credited. And from the parent's point of view, we also had investment in bonds. This was previously a debit, right? This was previously a debit, 101,500. And we amortized some of that in this line entry, 250, as a credit. So we now need to debit that 250. That takes care of all of the components from the parent's point of view as far as the investment in bond is concerned, as far as the interest receivable is concerned, as far as the interest revenue they recognized and the amortization they recorded. So as far as a parent is concerned, all of the bond related transactions have been eliminated in this entry. Let's take a look at what happened to the subsidiaries. The subsidiary had bonds payable on their books at $100,000. If you recall, that was way back up there as a credit to $100,000. So the first thing I want to do is get rid of the credit of $100,000 in bonds payable by debiting $100,000 in bonds payable. We want to eliminate any associated discount on bond payable, as well as any interest expense that was incurred. So the discount on bonds payable, this line represents total discount recorded at issuance of bond. This was $4,000. If you recall, we initially recorded $4,000 as a debit to discount on bonds payable. Let's eliminate that $4,000 as a credit, right? It was previously a debit. And so far, we have amortized 1, 2, 3, 4, 5 times 400. That's $2,000 worth of discount on bonds payable we have amortized as a credit. So let's debit 2,000 of it so that we can free our financial statements of those entries. And finally, the interest expense that pertains to 2015, because only in this year did this become an intercompany transaction. Prior to this, it was okay to be on their books. Prior to 2015, 1/1/2015, the interest expense on the subsidiary books is valid. But as far as 1/1/2015 and onwards, any interest expense that they incurred for the year needs to be eliminated, because this interest expense was an intercompany transaction with the parent. So what was the interest expense recorded in this particular year in 2015 from the point of view of the subsidiary? $8,400, right? And we can stop there. And you're going to notice that these two items are not going to balance out. The debits are 110,000, the credits are 113. So what we need to do is find a plug here that accounts for the mismatch I spoke about earlier. And the mismatch occurred once again because the bonds were issued in 2011. They were subsequently purchased by the parent in 2015. And both of those times, there were different things happening with the discount and premium. So when we do these intercompany elimination of these intercompany transactions, it's what we're really saying is that we are retiring these bonds, let's just say, and eliminating all associated entries with the bonds, so that we can free the financial statements of any transactions pertaining to bonds. And then we're going to consolidate the statements together as if there were no intercompany transactions, right? So that's where this loss on investment, loss on retirement, will come in. But even before we get to that, even before we get to step 2, you'll realize that these two blue lines here really are the same account. The investment in bonds, these two need to be netted out, and the discount on bonds payable, these two items need to be netted out, just so we could have one account that we're affecting change to. So I'm just going to go ahead and copy everything down here in the same worksheet. But really what I'm doing is I'm just netting these two blue items together. Then we'll find the loss on retirement. Okay. So interest revenue is still the same. That doesn't change. The discount on bond payable was debited 2,000 and credited 4,000. If you net the two together, you should end up with a credit of 2,000 in discounts on bonds payable. And I can go ahead and just enter the formula there as 4,000 minus 2,000, or just simply 2,000. That takes care of the first arrow here. The second arrow tells me that the investment in bonds we're eliminating was 101,500 minus the amount we amortized or destroyed. So 101,500 minus 250 is obviously a credit. Minus 250. And the interest expense, is still the same. The bond payable, still the same. And now we are going to, now we're going to deal with this issue of finding the plug to balance the equation. And not just to balance the equation, but to realize that we're eliminating or retiring a bond. And with it, if there's any gain or loss, we need to record that. In this case, as we noted, debits were less than credits, right? So we need to kind of deal with that by adding the credits, subtracting from them the debits, and that becomes the loss on retirement of these bonds. It's as if we retired the bonds because they were intercompany in nature, and next year we're going to issue them again, right? That's the idea behind this. At this point, the debits 111,650 and 111,650 match each other, and we're going to go ahead and ignore 2016. I hope that helps clarify this question a bit more for you guys. I know this is so new for us that I kind of wanted to take the time to go through this. If you have any questions, please reach out to me. And thank you again for your time.